Hey everyone, and welcome to The Explainer. Today, we're actually untangling the pretty complex threads of Reliance Spinning Mills Limited. Now, if you aren't familiar, this is a massive manufacturing powerhouse primarily involved in producing yarn, with its registered office over in Kathmandu and its main facilities located in Connor and Duhabi, Sansari. We're going to give you a really clear, objective look at both the immense scale of their operations and, well, the major controversies that have totally halted their public offering. Whether you're an experienced investor or you're just fascinated by how emerging market industries work, this case study is literally a roller coaster. I mean, we are looking at Nepal's largest spinning mill hitting a massive regulatory brick wall. So here's our roadmap for today. We'll be moving quickly through 6 key areas: Nepal's manufacturing giant, financials and earnings volatility, valuing the spindle, the NEA power dispute, the IPO controversy, and finally, untangling investor risks. Let's jump right in. All right, kicking things off with Section 1, Nepal's manufacturing giant. Let's see just how big this operation really is. The sheer scale we're talking about here is just staggering. RSML's capacity has exploded from around 9,000 spindles back in 1996 to a massive 127,824 spindles today. What does that mean exactly? Well, it means they can produce nearly 49,000 metric tons of various products every single year. We're talking everything from polyester, viscose, and acrylic to cotton blends, sewing thread yarn, open-end yarn, and vortex spinning yarn. And with a workforce of over 4,000 people, they are an absolutely critical pillar of the local industry in Nepal. But their business model presents this really fascinating contrast. On one hand, they rely heavily on global import partners to source raw materials, bringing in fibers from places like India, Japan, Thailand, and South Korea. But they offset that by absolutely dominating as Nepal's single largest exporting company. They ship massive volumes to India and Turkey, but their footprint also expands globally to the UK, Vietnam, Canada, Kenya, Portugal, Spain, Brazil, Cambodia, and Bangladesh. All of that generates around $50 million in international sales. So because RSML is so deeply integrated into the global supply chain, they're also incredibly vulnerable to things like global trade shifts, currency fluctuations, and changing international market demands. Moving right along to Section 2, Financials and Earnings Volatility. Let's talk about the money. Looking directly at the company's audited statements for the past couple of years, the top-line numbers are massive. Their total operating income recently hit around 10.24 billion rupees. But here's the catch. The margins are super tight. That income is heavily eaten up by intense costs. We're talking 6.12 billion rupees just for raw materials, and another 873 million strictly for power and fuel. Think about that for a second. When your energy bill nears 1 billion rupees, even a tiny disruption or price spike can just completely devour your profits. And that leads us to a really crucial point, the wild fluctuation in their earnings per share, or EPS. Just look at this roller coaster. It dropped dramatically from $54.34 in fiscal year 2080, all the way down to a mere $2.95 in 2081, and then suddenly bounced back to $27.87 with a net profit of $475.81 million in fiscal year 2082. Now, for an investor, consistency is everything. So when EPS plummets and spikes so aggressively, it really forces you to ask, are these earnings truly sustainable? And do the reported projections actually reflect the reality on the factory floor? Which brings us to Section 3, Valuing the Spindle. Let's unpack how they actually priced this much-hyped IPO. So RSML used what's called the book-building method. They set an institutional cutoff that resulted in a proposed price for the general public of 820.80 rupees per share. But the big question is, does that market price actually justify the purchase? If you're a seasoned investor, you know you have to look way beyond just that premium price tag. You need to calculate the implied PE ratio, the return on equity, and your overall ROI. You also have to ask, how does their projected market capitalization compare to peer manufacturing companies? And crucially, at such a steep premium, does the company actually have the long-term dividend capacity to reward its shareholders? When weighing that valuation, potential investors really have to balance a few conflicting factors. On the plus side, they have a very healthy 0.27 debt-to-equity ratio, and there's huge future growth potential from a brand new 9.2 megawatt solar plant they're building. That solar plant is a brilliant strategic move to slash those massive power costs we just talked about. But on the flip side, Care Ratings Nepal placed their 9.45 billion rupees in debt facilities, which includes both long-term and short-term ratings like Karen PA, on a credit watch with developing implications.
That tells us analysts are watching very closely to see if they can actually service that massive debt amidst all the current market uncertainties.
All right, Section 4, the NEA power dispute. Let's look at the first major roadblock they hit. If you dig into the financial notes, you'll find a staggering 753.7 million rupee contingent liability. This is a highly disputed electricity tariff claim from the Nepal Electricity Authority stemming from premium charges for dedicated power lines during the peak load-shedding years. Now, this is a very serious litigation risk because if the company is ultimately forced to clear this full amount and recognize it as an expense, the impact would be devastating. It would wipe out massive chunks of their working capital and severely cripple their short-term liquidity.
The immediate crisis was actually pretty dramatic, but it was temporarily averted through a series of steps. Picture this: a complete power shutdown temporarily idles all 4,000 workers at the plant. Eventually, the Prime Minister and the FNCCI step in to broker a compromise, splitting the total claim into 28 installments. This allowed RSML to turn the lights back on and resume operations by paying a 27.7 million rupee first installment, which they paid under protest. Imagine a factory capable of producing over 125 metric tons of yarn a day going completely dark. While the power's back on now, they're paying these installments under protest while fighting it in court, which means this massive financial shadow is going to follow the company for years.
Now, let's get into Section 5, the IPO controversy, and analyze why the regulators hit the freeze button. So, the Public Accounts Committee and CBON officially suspended the IPO just days before it was supposed to be issued. They demanded serious, immediate clarifications on the company's financial disclosures and pricing. This is pretty unprecedented. You literally have thousands of investors ready to participate, and suddenly the regulators pull the emergency brake, citing the need to scrutinize the financials much more deeply. We're basically looking at a classic standoff. On one side, lawmakers suspect the financial details were manipulated to justify that exorbitant premium price. They specifically point out those wild EPS swings and the fact that the company didn't formally provision for that massive NEA debt. Meanwhile, the company firmly maintains its position. They argue they simply provided valid, audited, good faith assessments of their current standing. Their stance is that since the NEA dispute is still tied up in court, it doesn't need to be provisioned as a direct loss on the books just yet. Now, our goal here isn't to take sides. We're simply impartially reporting the facts. But it's clear this is a fundamental disagreement on how financial realities should be projected to the public. Finally, Section 6, Untangling Investor Risks. Let's bring it all together and look at the complete risk profile. Let's lay out the bear case, because it presents a real gauntlet of systemic hurdles. Beyond their heavy reliance on imported raw materials, fluctuating export demands from places like India and Turkey, and intense energy costs, there are some hidden traps here. For one, investors face significant valuation risk. Is the stock price already fully discounting their future growth? Add in currency and trade logistics issues, receivable risks where delayed customer payments squeeze working capital, regulatory and IPO suspension risks, and the unpredictable nature of manufacturing cycle downturns, and you've got yourself a highly complex, tangled risk profile. So we come back to our main question. Ultimately, when you balance their undeniable manufacturing dominance against these severe financial discrepancies and legal controversies, does an 820.80 rupee price tag justify the investment? Or is this a web you'd rather not get caught in? It really is a fascinating case of industrial scale colliding with intense regulatory and financial complexity. I highly encourage you to dig into the audited reports yourself, weigh the incredible potential of their new solar infrastructure against their massive contingent liabilities, and see where you personally land. Thanks so much for joining me for this explainer, and remember to keep asking the hard questions.